Schwab, ACG Silicon Valley CEO. I can't believe we're having an in-person event today. Welcome. It's a real pleasure having you all here. And I would like to thank our host, BNY Mellon Wealth Management, for not only organizing but hosting the event tonight.
Yay!
Mark. As many of you already know, ACGSV is the leading business-to-business networking organization in Silicon Valley, providing connections, thought leadership, and enabling personal and organizational growth. And we offer a variety of networking opportunities, and with 14,000 members in 59 chapters across the world, we offer local connections with a global reach. So ACG Silicon Valley has a couple of virtual events coming up in the next months, and that includes our M&A circle on IT risk post-pandemic. It also includes an event on data and supply chain. We also have an event on networking for today and tomorrow, and a discussion on ESG. So check our website at acgsv.org and make sure to sign up for our upcoming events. And now, without further ado, I would like to introduce you to Mark Jameson for BNY Capital, who will be our moderator today for the event titled Navigating Capital Markets Cross Currents. So here's Mark.
Wow, sounds exciting. I like it. Thanks, Yvonne. So good evening, everyone, and thanks for joining us today. It does feel good to have an in-person event again, and hopefully this is one of many that we can do moving forward. As a sponsor of ACG, we try to do this once a year, and it was interesting when Yvonne and I were talking about talking points for today. She reminded me that it was this same panel 2 years ago on January 29th, 2020, that we had our last in-person event for ACG, period. So almost 2 years ago. And what was interesting is at the last minute, the night before, I was getting a lot of feedback that we should provide at least some dialogue on the pandemic. And so I had to change my script and added, the panelists all said it was something we need to keep an eye on, and something that needs to be addressed, but none of them thought it was going to be, a major issue. And obviously, 2 years and quite a battle. But so I encourage everybody to stay safe this evening. Please wear your mask if you're not eating or drinking, and try to maintain space and everything else, because we want to make sure we take care of everybody as we do these in-person events. If you do need the restroom, it's in the back corner. Lynette and Carol can show you the way. And what we talked about before, the goal of the panel today is really to provide an interesting perspective on the capital markets from industry leaders, and I'll introduce the panel here in a moment. They can cover everything from angel investing, venture capital, private equity, M&A advisory, and just general investing, given the dynamics of today's environment. From an agenda perspective, we'll have probably formal remarks on the panel till about 6:15. And then from 6:15 to 6:30, we'd love to hear what questions you have for the panel. So we'd love to interact with the audience. And then from 6:30 to 7, we'll continue to have refreshments. We could probably have more food. We probably budgeted a little bit more than we're here today. So feel free to take some home, feed your family, or whatever it is. So, and I did want to just say special thanks, to our panel for taking time out of their very, very busy schedule, because they are all in the throes of what is, high activity, in the capital markets today. So I'll introduce the panel. All the way at the end is Joey Hawk. Joey is a senior director with BNY Mellon. And then next to her is Aman Johar, principal with Proteum Capital. Rob Carlson, who's a partner with Sidley Austin LLP, and Homan Yoon, who's a partner with Fusion Fund. So to start the evening, what I wanted to do is have each panelist share a little bit more about their practice, the current market that they are in, and some of the key challenges that we see moving forward. So we're actually going to start with Rob.
Okay, great.
And do you need a mic by any chance? I mean, hopefully you can hear me well.
I can talk like this.
Yeah.
Good. Mark said, I am Rob Carlson. I'm a partner at Sidley Austin's Palo Alto office. I'm on Page Mill. Been a practicing lawyer for 26 years, and I do mergers and acquisitions. I represent buyers and sellers of companies. I represent companies and investors in venture, growth equity, and later stage equity investments. And I represent sponsors of venture capital and private equity funds, and the occasional public company thrown in there as well. The industries I cover are technology, fintech, a little bit of blockchain, but I would never pretend to even have to know anything about it. I can barely say Ripple, or Ethereum, and life sciences. I represent biotech companies. I represent healthcare IT companies. So what I would say for the last year and 8 months since COVID has been a whirlwind, a complete, when COVID started, every law firm did the same thing. They froze hiring. They said the market was tanking. All we were doing was PPP loan applications for clients. Even the company that was a biotech company that was also working on a COVID drug to deal with the cytokine storm associated with COVID, and this is a public company, was taking PPP money. And then we got to late in the summer when the introduction of SPACs. And I have done SPACs off and on for 20 years, and I have a different view of SPACs than probably people who have spent the last 2 years doing SPACs, because I remember all the redemptions and all the problems with SPACs from the late 2008, 2009, trying to get a SPAC deal done where we had to recut the deal 3 times because we were worried about redemptions. But the SPAC market was the way back out to the public markets. It was the way back out to doing deals. And people went from having conversations about, well, I couldn't possibly invest in a company or buy a company if I can't go there in person. I can't possibly do these things remote. To, oh yeah, I'm in. We'll do this. The fear of missing out, all the other things we learned that we could use Zoom. My kids still use Zoom better than I do, but we could do this. And so Q3 and especially Q4 last year, the activity picked up. I did 44 deals in 2020. I've done 75 this year so far in 2021, and I've got 20 more in the hopper that all want to get done year end. It has been, insane. We're paying bonuses to our associates left and right to get them to please stay. You want to work remotely, fine, we're fine with it, we'll do what we can. And it's been at all levels. I think the restructuring lawyers got excited back in early 2020 when COVID was happening. They thought they were going to be busy. And they didn't wind up being particularly busy. Some industries, hospitality, travel, real estate, perhaps suffered some more. But in technology and life sciences, funds, there's 1.5 trillion of capital available in PE funds. There's 7 trillion of cash that companies have. There's 200 billion of SPAC money that's been raised that's looking for the de-SPAC transaction, the M&A acquisition. And there's a pipe market that has been strong, has been tapering off in the de-SPAC world that we can get into later. But in terms of headwinds that I see, we'll deal with it later, but what I worry about from a deal perspective is increased regulatory environment, antitrust. Our antitrust lawyers it's funny, I have a good friend is an antitrust lawyer, and she spent all her time in the European Union for the last 20 years. And now she's doing US. Because, if you're a tech company, antitrust is one of your big concerns. The early termination period is over for anybody who's looking for early termination on a deal. It's over. The FTC is not doing it. And they were doing second reviews on many more deals. So I worry about that. I worry about, of course, rising interest rates with inflation might have the effect on that. Whether the availability of debt will become an issue. But for now, at least now, it's still a very robust deal market.
Come on, you want to take over?
Sure. Let me know if I need a mic or just
You're
please
good.
okay. So I'm Johar. I'm with Protein Capital, and the last 12, 13 years that I've been in the Valley, my career path has been very non-linear and winding. I've dabbled as an entrepreneur in a biotech company we sold to a Canadian pharmaceutical. I've been running a fund where we were investing in distressed assets, turning them around and making them good M&A opportunities for all the major big companies around the Valley. In the last 4 or 5 years, I've been really focused a lot in the blockchain space, starting obviously with the big daddy Bitcoin, but now the DeFi ecosystem and what we're seeing in the NFT craze is just humongous. Even though I've been in the space for a while, it always feels like I'm 6 months behind where the market is. But it's exciting. It's pretty exciting to see where things are going, and the challenges, like previously mentioned, they are there, but I kind of look at it on the other side and see, okay, what are the solutions that can be provided to overcome those challenges? And one of the things that my non-linear career has allowed me to do is really connect the dots in different industries, in different environments. And a good example of that was last year when everything was shut down. I got thrown into the world of sports and entertainment in a big way, where every stadium, every arena throughout the world was shut down. And what do we do? How do we start to reopen and build back the confidence that was lost? So we ended up creating a task force, a national task force of all the major leagues, the venue operators, the promoters, and we started to put together guidelines on how to get them back up and running. And then as part of that, one of the other opportunities that came out my way was investing in a company that's making a COVID testing device that can test COVID in about 20 seconds. So that's now under the FDA purview, so not allowed to talk a lot more about that, but hopefully we'll get through by the end of the year. And then we published a set of guidelines on how these venues, what kind of safety operations they need to do, what kind of risk mitigation they need to have in place. And as we were going through that whole exercise, it became very clear to me that the world of sports entertainment is ripe for something that's happening now in the NFT and the blockchain space. So again, a merger of these two very different worlds. And the last 4 months or so, I've now stepped back into an entrepreneurial role where I'm creating the NFT brewery, and we can brew NFTs, whatever flavor, whatever sizes you want. One size does not fit all. Everybody wants their own extra cream or extra hot or more.
You're going to talk a little bit more about it.
Yeah, we'll talk more about that. So that's what I'm doing, and yeah, we'll talk more on those things and the intersection with capital markets too.
Let's go all the way to the end, Joey, and then we're going to bring it back home.
How do I follow on? I am a senior director at BNY Mellon in San Francisco. So what does that effectively mean? That means I spend my day doing meetings and email. So I've been about 16 years specific to the wealth management industry. Unlike Aman, who can do many, many things, I can only do one, which is wealth management. I'm a CFA charter holder. I'm actually driving down, I realize I'm tardy in paying my dues to the state of California, but I am a licensed but tardy CPA. I'm also a certified private wealth advisor. I oversee the team in San Francisco, and I think we roughly manage about $5 billion in assets. So when Mark asked me to kind of prepare some comments about the market outlook, it comes back to this question that I get so often from clients, prospects. If I happen to hop in an Uber and tell them what I do, they always ask me the same thing: what is your outlook on markets? Right? Basically, trying to read the tea leaves a little bit. And when I take a step back and I unpack that question, oftentimes it's an investor trying to figure out, is this a good time to put money in the markets, or is it a good time to take money out? And the answer is so uncertain, and it's always uncertain, and even more so now, right? So let's explain why it's more uncertain than ever. Valuations are stretched across the board, right? If you happen to pick up any financial publications, the S&P 500 hits record new highs more often than my 4-year-old takes a swing at my 2-year-old. And if you look at risk control assets, right, the old-fashioned idea of when you put risk assets in a portfolio and risk control in a portfolio, one should zig when the other one zags, was called into question for most of 2021. It wasn't until October that you saw that relationship normalize. And oh, by the way, if you buy a 10-year treasury bond today, you're getting paid $1.60, right? Inflation's 4 or 5%, so you're actually buying into negative.
And you're losing money.
You're losing money, right? So is this a good time to invest? Unfortunately, I don't have a good answer for you because it's very specific to a particular client. I need to sit with them and understand what's the utility of your wealth, right? And what I mean by that is if you tell me that I'm going to use these funds to buy a home in Aspen within the next 2 years, that's a very different asset allocation that I would create for that particular piece of wealth versus I'm going to use these proceeds to fund an educational trust for the next generation. So Mark, I'm sorry to disappoint you. I can't answer that question. I don't have a good answer for you. Work it out.
Sounds good. So Homan, we'd love for you to tell us more about your practice and some of your observations, but I want you to also sort of move forward and give us your perspective on the current, funding bubble, and should we be worried?
Yeah, great question. So yeah, I'm Homan Ewan. I'm a partner at Fusion Fund. We're an early stage firm doing deep tech and healthcare investments, primarily seed stage and early series A. So we look at sectors in like industrial automation, enterprise, and healthcare. We invest across things like medical devices, AI, robotics, and other sorts of AI in enterprise applications. So my background, I've been pretty technical most of my life. Berkeley physics and then PhD engineering at Stanford. Ended up starting a solar cell company in the first clean tech wave in the 2000s. And I'll talk about this apparent clean tech 2.0 wave coming on. So rode that wave up, rode that wave down, but had a good exit out of that company. And then joined my partner Lou Zhang here at Fusion Fund, who started the firm. And I've been doing VC now since 2015. And so it's kind of funny that I've been saying that the market has been too frothy since like 2016 and predicting some downturn to happen. And so when COVID hit, we like many other VCs sent out the memo to our founders, okay, this is it, this is the downturn everyone said was gonna happen, cut burn, cut heads if you need to, just get ready for a tough environment, collect revenues, all that fun stuff. So it looked pretty appreciative for the first 3 months, and then you start seeing things turn around. But it's been such a weird, from pure negative to pure positive. And now as an investor, we've never seen valuation so high, we've never seen deal velocity so high, we've never seen deal volume so high. It's just complete insanity. We were joking in the early days of COVID, like people just bored, so that's why they're just doing deals. Nothing to do with it. They're just doing deals. But it's still going. I think to what they said, there's definitely a lot of FOMO going on. Everything's up and to the right. So people are wondering when does it stop? But the train keeps going, so you keep jumping on that train. So to be honest, I don't see what slows this down. I think next year remains to be very similar. There's just so much dry powder in the ecosystem that has to be deployed. And you're seeing all these, I would say, non-standard VCs like Tiger Global, Co2 come in at the growth stage, flood that market, which then forces the sandhill investors to then go, oh, I need to get in earlier because I'm losing the Tiger. So then, us at seed stage, we're seeing Sequoias and NEAs come in with crazy term sheets at seed stage. And so we sit here wondering, okay, valuations are now 5 to 10x higher. Will exits be 5 to 10x higher? And I think that's the big question. And I think everyone right now is saying that's going to be the case. There definitely have been lots of SPACs, lots of IPOs, lots of M&As, but does that keep going? And so I think we're seeing a lot of new companies being formed because it is true COVID did really accelerate a lot of things, technology adoption, technology solutions, but also when companies laid off a bunch of people, that's how the dislocation is usually when all these new early stage startups form, right? Every recession generates a new batch of just startups. So like when Airbnb or all these companies laid off a third of the workforce, where do people go? I mean, all these tech workers are typically very wealthy, and so they had good ideas. So we're seeing this huge influx of early stage companies go through the ecosystem with a huge amount of capital. And so along with that, we're going to see, for us as an example, we see companies, we tell them, hey, 20 million valuation is a little rich, like, can you kind of be more reasonable? And then the next day, we'll see a Samuel firm come in with like a 50 million valuation term sheet. And of course, they're going to take that term sheet, so we can't win that. The question is, do we make a bad call not trying to compete with that, or is that the right decision? Because maybe in 5 years, like the market tanks and everyone's doing down rounds. But definitely, we're not the only firm dealing with this. Everyone in the ecosystem is dealing with this. It's a great time to be a founder. You say like, maybe I should go back and become a founder. Everyone's getting funded at very good valuations, and the question is, can you sustain that valuation at each round, right? I've posited that I think in about 12 to 18 months, we may see some downturn at the seed stage, just because, when a sample firm comes in and funds a seed stage company at 50 million valuation, that's a high mark to live up to. If you don't hit all your metrics, like what happens? Do you maintain that 50 million valuation, or then do you have to raise at a down round? So there's so many seed companies that have been funded. It'll be interesting to see over the next year and a half whether this batch kind of survives, or we see a culling of the herd, so to speak.
Thank you, appreciate that. So Rob, you mentioned SPACs when you were first doing your introduction. I was hoping you could maybe educate us on like what a SPAC is.
Sure.
And in addition, sort of share, are they here to stay?
Sure. SPACs are special purpose acquisition companies. They go public as blank check companies. So when you invest in them at $10 a share, they are telling you you're investing in a sponsor of a SPAC. A little bit like a sponsor of a VC fund or a PE fund. But you're specifying in an indeterminate company, the sponsor's going to take your money and use it to buy a company, to be identified. Within 18 months or 24 months, depending on the terms of the SPAC. And at the time of the acquisition, which is called a de-SPAC, the shareholders of the SPAC will have the chance to vote on whether they do to approve the deal or not. They have a separate vote on whether they want to have their shares redeemed or not also. That redemption is at a fixed price. It's the $10 per share they paid plus a nominal interest rate. This was very popular in 2008 when we saw the financial crisis. Hedge funds needed some kind of return. SPACs were actually a guaranteed return for them. You invest in a SPAC, you decide up front, I'm going to redeem it. Bingo. I don't have to even stick in the company. So I think SPAC sponsors smartly knowing that, seeing the advantages of the concerns about redemptions, also smartly realized that there needed to be a strong PIPE market for that. PIPEs are private investments in public entities. And a PIPE is an investment by an investor, usually a very well-known institutional investor, in the stock of the combined company, the public company that results from the acquisition of the private company. And so the PIPE doesn't close until the acquisition closes, but it is an investment in the public company. And so SPACs, you form a SPAC, you do the de-SPAC acquisition, you do the PIPE and companion, and you're on your way. So when SPACs became popular, it was the formation of them. And now what we're seeing, I think there was a record number of SPACs formed in Q1 of 2021. There's a lot fewer SPACs being formed right now. But it hasn't had an impact on M&A because so many of those SPACs that were formed in early 2021 haven't done the de-SPAC deal yet. So if you're a target company, you are still talking to the usual strategic buyers, PE-backed buyers, and SPAC buyers, and those folks are out there still in the market. The other thing about SPACs is it lets you, in the de-SPAC transactions, some of the disclosure requirements are not as significant as they are for IPOs. You can talk about forward-looking statements. Now the SEC is looking at this. They're both looking at it from an accounting perspective, and they're looking at it from a disclosure perspective for investors. Is that we create an environment where de-SPAC disclosures are not consistent with IPO disclosures or direct listing disclosures. So I expect more regulatory issues around that. As far as whether SPACs will continue or not, I'm very bad at prognosticating. Somebody said once, it's really hard to predict, especially when it's about the future. So that definitely applies to me, and I'm a lawyer, so, when lawyers get into something, that's when you know things are going down. So, and from personal opinion, and whenever I talk to a lawyer who's investing in blockchain, no offense, that's when I start to get worried. But anyway, I think they are here to stay to some extent. One thing that Joseph Grunfest, as a professor at Stanford Law School, talks about a lot is we in America, after Dodd-Frank, after the implosion in 2001, 2002, the number of public companies in the US dropped precipitously and continued to drop precipitously. We all focus on the IPOs and the public companies and the Facebooks and the Teslas, but the number of deals, the number of public companies has continued to drop. SPACs was in part a response to that. It was a response in part to companies were staying private for as long as they possibly could. Facebook, you name it. SPACs were an answer to that to some extent. And I think that a SPAC that is sponsored by a solid sponsor with a strong management team. I've got friends that are on boards of SPACs, and they know what they're doing, they know the risks. What I worry about the SPAC market is there's so much of a SPAC ecosystem that cares only up to the point that the de-SPAC happens. And that's the end of it for them. They're on to the next SPAC. They've got 4 more to do. That company is now a public company and it has a life. It needs to go forward. It needs to have analyst coverage. It needs to have a strong management team. It needs to have revenues. It needs to have all these things. And I worry that in this SPAC environment, we're not focusing on those things.
So isn't it management's job of the acquired company to focus on those things and build up their stock and all that? I mean, the promoters, as you said, they're gone.
Promoters are out of there. If I'm talking to a management team of a company that wants to sell to a SPAC, to do a de-SPAC deal, they need to treat it like an IPO. That is exactly what it is for them. And they know it. A lot of them know it. But you're getting with no analyst coverage often. There might be a bank that's behind the SPAC. They're behind the sponsor, or they're behind the management team. You got to make sure all these folks. That's where the PIPE market can help. I've represented PIPE investors in SPACs, and the fact that they're backing that company gives a lot of confidence around the company and what it's doing. But it's still, it's a tall order. I think there are still investors, maybe not younger or newer investors, but there's still a lot of legacy investors who look at SPACs very skeptically.
So is the PIPE market still, I would call it, for years has been toxic in my mind with huge discounts and race to the bottom, but how's that PIPE market changed?
At the beginning of the SPAC, when in the time of when valuations were hot, the PIPE investors were not able to dictate terms as much. But I think now that you're seeing the PIPE demand, so the need for PIPEs is greater because there's higher redemptions, because people want out, the people that invested in the SPAC. So the PIPE investors have more leverage now, so they can argue for the deeper discounts, they can take more warrants, they can make this cap table look more messy. I like a clean cap table. I don't like common stock, preferred stock, of warrants in a public company. What the heck do I own as an investor? And that's what I see. Again, as a PIPE investor, I'll take whatever I can get. So I think that's what I have a concern about. Now I say all that, I've represented American Airlines. I did a deal, we did a commercial deal for American Airlines. It's one of these electrical vertical takeoff and landing plane companies. It's called Vertical. Our firm also represented United in the Archer deal. You guys may know Archer. Same company, same type of company in Palo Alto. No offense to electrical vertical takeoff and landing, it's cool stuff. I think it's great. It's really exciting. But we did pipes in both, and we'll see where it goes. See where it goes. Do we need 2 companies in electrical vertical takeoff and landing? I don't know. We'll see. Then we also have Joby.
So we can get back to SPACs at the end.
Yeah.
I do want to move forward with some of the Q&A. And a topic, Mon, that you actually mentioned was NFTs. I think it stands for non-fungible tokens, and we'd like to learn about that. I understand it's getting a lot of PR. I think there was the largest NFT conference in New York was actually this week. So if you wouldn't mind, educate us a little bit more on your expertise and share a little bit more. What is NFT, and why the buzz?
Yeah, so NFTs have been around for a few years. It's not that they just popped up on us this year, but people have been working on these digital tokens and assets for at least 2-3 years now, right? So what really is an NFT? It's called a non-fungible token, where everything is a digital representation, but it's a unique digital representation of whatever the underlying asset is. Now think of it this way, that your dollar bills, every $1 is fungible with any other $1. Yes, it has a serial number, but that's mostly for tracking it, but the valuation, everything else is the same. You can exchange a dollar. But the real world, if you think about it, everything is non-fungible, everything is unique. I can guarantee that, we have so many of these chairs in this room, and if you put it on Antiques Roadshow, they'll come up with so many different variations and so many different attributes for each one of these chairs that nobody will say that these chairs are not unique items in themselves, right? So that's what in a kind of a roundabout way an NFT represents any object's unique properties and unique attributes that can be associated with it. And these objects don't need to be purely digital. They could be physical objects too that can be digitized. They can be hybrid of physical and digital that can make it happen. But the biggest buzz has been so far, and this year has really brought this play about, is I think around March or so there was this one huge collage that an artist created that sold as an NFT at the Christie's auction house for $69 million. And that brought NFTs to the forefront, and everybody jumped onto that bandwagon and said, okay, we need to do something about these NFTs. Now that it's completely debatable, and I think we should debate about what is the real value of that image that is publicly available for everybody else to download and do whatever they want to do with it. But then it is also married to this very unique digital token that now becomes the asset that's married to that image, right? And somebody did pay $69 million for it. So there's that valuation, talking about craziness in the early stage markets, right? So I think my view here is that the NFT space is actually redefining what it means to own something. And it's really challenging the concept of ownership itself as we've known it for a long period of time. And that's probably the beginning of the NFT revolution that we're probably seeing, that will unfold in so many different ways going forward. And maybe it won't even be called an NFT in the future, it may be called by another name. But the idea still remains that it's representing something unique. You have a provenance of it on a blockchain that can never be altered, that can never be modified. And for everything that you want to do with it, going from that period onwards, you know exactly when that thing was minted. So another example that often comes up is about the Mona Lisa, right? So we all know that, or we've been told that, yes, Leonardo da Vinci painted the Mona Lisa, right? But is there a foolproof record of it anywhere in the world? I don't know that, but I've been told that there is not, right? And then there's a lot of, but again, this is where blockchain steps in, and it creates that first provenance of whenever that asset was created. Now, we're starting to see, so what started off purely as JPEG images being sold for millions of dollars, we've seen that concept evolve into smaller communities, very tight-knit communities that believe in something. And this is where I would like to say, I think this fact was not lost on Facebook when they rebranded themselves as the Metaverse, right? But what does a Metaverse mean? I mean, a Metaverse cannot be 4 billion people on one application. I think a better definition of a Metaverse is 1 million different communities with, say, 4,000 people each, right? And now that starts to relate back into this NFT space where you're saying, okay, can I, as part of that strong community, can they be represented as unique individuals, as unique communities? Can we enable unique functionality amongst those communities? And the biggest example here was this NFT prop that was created. It was called the Moored Ape Yacht Club. I don't know how many of you might have heard about it, but those what they did was they created only 10,000 these NFTs, and they just let people go out and claim ownership of those. But once they were gone, they've now started to create a community around those 10,000 people. So if you were an early owner of that NFT, now you start to get extra privileges for belonging to that community. And that, I think, is a better definition of a metaverse. Now, if you have 10,000 dedicated people, what else can you do about that, right? Now, all of a sudden, your advertising models to that community can start changing. Your ownership models of what it means to be part of that community starts changing, right? And then where it intersects with the capital markets is these guys actually went out after the first sale of those 10,000. They actually went out and sold another 10,000 and raised $96 million in 1 hour, right? Now that is where you start to see, and companies that are now starting to get formed, they have these case studies in front of them. They now see, do I need to go to a venture capitalist to fund myself? Do I need to go to public markets to fund myself? Or can I just bootstrap enough and create a good community where I have a token, I have a coin, I have something to offer that's very valuable to that community and raised directly from that community. So now it starts to redefine your concept of even creators and their fan followings, right? As a musician, yes.
So Mom, how do the purchase of those tokens monetize them?
Well, right now it's all very frothy and speculative, but if you bought that Bored Ape early on, the market's really pricing it out for them. Right?
So is there a secondary market?
There are plenty of secondary markets for those. So the biggest one is OpenSea, where you can go out and list your NFTs and let the market price it out. You can put it up for auction, you can put it up for sale, and say whatever best offer I get, I'm willing to sell at that price, right? So now that starts to create, again, floor pricing for these items when a large number of people think that, this is what I'm willing to sell it for. That's market-based pricing. And I think that's most transparent as you see with other assets too.
Man, that was a great description and very complex. So
Well,
we appreciate that very, very much, for sure.
Let's move, keep moving. But happy to talk more.
So Joey, Holman has a founder going through a Series 3 or a Series C, $100 million, unbelievable. Comes to you and he's like, I wanted to start investing for the long term, but I think I should wait for a market downturn before we start moving forward. How would you handle that type of situation?
So you're effectively asking me if it's a good time to invest.
Yeah.
You're trying.
I'm trying a different way to
Well, I think a surgical level of precision needs to be made with regards to the asset allocation, especially for a young entrepreneur in that case, right? And the reason why I say this is, I honestly don't know what markets are going to do in the next 12 to 18 months. And I think anyone who purports to say they do know, I would hold on to your wallets a little bit. In the chart books, which I'm not sure if all of you have, I look at data, right? Because data gives me something to at least stand on. And I think it's the first chart, if I'm not mistaken. I have 2 bar charts. And the first one looks at what markets do after a 10% decline. So after a 10% decline, my intuition is markets are going to go up, right? There's been a haircut, money's going to pile in, I'm going to experience outsized returns. And the answer is no. It's actually 1 year, it's relatively reasonable after that, right around the average, 10%. 3 years after that, 5 years after that, kind of level. So let's flip the script. What about market highs, right? So after market highs, what's your intuition tell you? The market's wobbly, it's gonna shake, it's gonna fall, reversion to the mean is gonna occur. I'm going to experience lower than average returns 1 year, 3 year, 5 years. Also no, right? If you look at the chart, I think it's a little bit higher than average, 11.8%, kind of levels out around 10%, levels are around 9%. So when a client comes to me and asks me that question, I will honestly say I have no idea what the market's going to do, but let me show you the data. And if they can get comfortable with the data, then perhaps it's an opportunity for us to talk about where to put their assets. But again, going back to that is a very critical part of your asset allocation, because going back to my earlier example, if you're gonna use those funds to pay a bill, pay your kids' education, buy the house in Aspen that will give you more space to work from home, it's very different from how I would allocate, again, those funds that you're gonna use to fund an education trust for future generations. So if you're working with a wealth advisor, they should be asking you these very detailed questions, because a 60-40 portfolio does not apply for everyone. So I realize I'm going off tangent, but to answer your question, I think is I'm uncertain. I would have to meet with that particular client, figure out what their goals and objectives are, and then put together a portfolio.
So what if that same client came to you and just said, well, we need to look at assets that are gonna do well in an inflationary environment, because I think there's gonna be a lot of inflation moving forward. So how would you then talk about that much?
Yeah. So let me present the two main perspectives on inflation, right? So, and they've got excellent data on both. So on one side of the inflation question, right, there's a lot of talk about it being transitory, right? It's gonna subside. The high rates of inflation currently not so important. It's gonna normalize. And they generally point to two underlying components of inflation there. High energy prices, and we saw today that OPEC's not gonna increase their production, so pain at the pump is probably gonna last for a little bit longer. But high energy prices, right, leads into everything that we do. Half of, I think 25% of the cost of a burger that you eat is energy. And then the second thing that they point to is supply chain disruptions, right? And I've at least experienced it. My heating element on my dishwasher broke November 2020. I still don't have a heating element. I actually went out to buy a whole new dishwasher, and I'm pretty sure the company from which I bought that heating element is no longer in business, right? And you see that if you're going out to buy a luxury watch, you're kind of SOL, because there's apparently a very high demand for luxury watches and not a lot of supply. So they point to those two factors, energy and supply disruptions, as temporary, which is why inflation is going to go down. And on the other side of the argument is that, you know, inflation is going to be a little bit more persistent, right? And they look at factors such as, okay, well, there's a massive labor gap currently. I think we're all kind of experiencing some version of that. I was chatting with Will. He's struggling to find associates for his firm. We're struggling to find associates for BNY Mellon too. So let's go back to Econ 101. You've got supply and demand, right? When something needs to move up, the price has to move up, right? So wages are going to increase. So higher wages, higher inflation. Also looking at the cost of housing. The cost of housing outside of the Bay Area, this is not Bay Area specific, has increased about 9% since this time last year. That's a massive increase in cost, right? So those two components I think are a little bit stickier when it comes to inflation. And last but not least, show of hands, how many of you think inflation is going to stick around a little bit longer? Inflation expectations are one of the biggest driver of inflation. Why? We're solipsistic, right? If I think my car's going to cost more next year, I'm going to go out and buy it, right? Who's going to wait? Oh no, I'll pay a higher price next year. I'll just wait, right? So when you go out and you increase that demand, it increases the prices. It's kind of a self-fulfilling prophecy.
And aren't most of the experts in the Fed, was one of them, were saying inflation is going to be transitory. Almost all of them have backed off from that position, haven't they?
You are so right. If you look at FOMC minutes from this time last year, inflation was mentioned 8 times. If you looked at the minutes, I think from the September meeting, 86 times. So I think they are starting to back off on it, but okay, let's zoom out a bit. Going back to that client who's a little bit concerned about inflation, I go back to data. So I take data going back to the 1950s, which captures that high inflationary period of the 60s and the 70s, right? So what does it tell me? Well, yes, it does have an impact on risk assets, but at what level, right? So when we look at that data, anything that's beyond 4% of inflation tends to impact risky assets. It tends to then haircut the evaluation of risky assets, right? So said in layman's terms, equities probably won't do so well in an inflation period that's higher than 4%. And I zoom out. Let's go deeper. 1927 to 2020 is the data that I was looking at. So in that time frame, there were 47 periods where inflation was higher than the median. actually risky assets are a good hedge for inflation. Not a great hedge for near-term and intermediate inflation, but certainly corporations and companies, right? Once you have inflation in the economy, you're going to push those prices back out to your buyers and sellers, right? You're not going to eat that cost of inflation. So when you're thinking about portfolio construction, right? I need a solution for any short-term needs, right? So in that case, again, going back to the risk control component of your portfolio, think about cash, short-term treasuries, because again, those should be married against any objectives that are near-term. I need a hedge for intermediate inflation, right? We can talk about that. And then I need a hedge for long-term inflation. So when you think about portfolio construction, you should be considering all aspects of inflation in your portfolio already.
So what, I think Mark's question was, what sectors do you advise your client to go into to hedge those various phases of inflation?
So on the short-term side, certainly there's no perfect hedge against near-term inflation, right? On the intermediate side, there's a lot of alternatives out there, right? I would suggest an allocation to Treasury inflation-protected securities, as unsexy as they may be. There's a perfect hedge to inflation in there, right? So it's baked into CPI. So if CPI goes up, you get an additional payment. Right there, I would say you'd probably be a little bit leery about the duration of that particular product, because if interest rates go up, you're kind of locked into an intermediate to long duration bond. But again, that's why you take care on the short end, right? And on the long end, right, equities, as I mentioned, looking at the data, tends to be a pretty good inflationary hedge. So you want to make sure that you
But
have
which sectors within the equity markets tend to be better than others?
I don't go deep on the sectors. It's probably a little bit unpopular to say, especially working at BNY Mellon, but I look at the fact that generally speaking, the betas of all of the sectors kind of look the same anyway. So I think of it as an entire bucket. Does that make sense? So basically,
So you're in that regard, you're considering sort of growth stocks and blue chip stocks. You're looking at all the same.
yeah. And the reason why I look at
Irrespective of whether they're commodities or high tech or financial services, et cetera, you look at all that the same.
Yeah, because I'm trying to put together a strategic portfolio, right? And when you look at the different sectors of capital markets, right? Some people chop it by industry, finance, utilities. Some people chop it by valuation, growth versus value. Generally speaking, when I say the betas are generally the same, they tend to move in lockstep with each other, particularly in very distressed environments. Correlations go to 1 in distressed environments. So you can have tiny little bits of correlation here and there, right? Maybe you try to put a portfolio of utilities against finance, maybe you put some high-tech stocks in there, but when fit hits the shan, all the same way.
Well, you definitely passed your CFA test.
Actually, fun fact, I failed level 3. And the reason why is level 3 expects you to kind of do the industry, and I just went off on my portfolio construction and I failed. And I was like, oh.
Yeah. So I want to move on to another interesting topic. This is an investing topic, and it's something that we get asked of our clients all the time. That's environmental, social, and government, ESG. And in particular, it seems like climate and sustainable technology companies are getting a lot of press. So, Omen, you're a former entrepreneur and was in this space before. Is this something? Is this another bubble? Is this something we should be concerned about?
It's a great question. I would say like mid 2000s when the last time we saw a huge amount of capital interest go into clean tech, sustainability. And it seems to go in 20-year cycles, right? The previous time was early mid 80s, and I would say that was first generated by the oil prices. People were realizing, okay, we got to find new sources of energy. I think mid 2000s was a combination of that plus caring a little bit more about the environment. And this time around, 20 years later after the previous cycle, seems to be a little bit more driven less by energy prices, but more about the human desire to be less harmful to the environment. So it's interesting to see the motivations change. And so the question then becomes, what does that change the demand and behavior of people who want to buy these type of products or businesses? Part of the problem with the last clean tech wave was that all this money from venture flooded in, but ultimately you were trying to buy and sell commodity products. For example, electricity. You're buying an electron. That electron is the same as that electron. There's no difference between the different electrons. So whether you're trying to do batteries, energy storage, like software type margins in that. So one of the biggest problems with the previous fintech wave was, does that business model actually work when you take away subsidies, when you take away customer demand, and all these different things? So look at today, and I've looked at a lot of companies, I personally still think that the business models haven't really changed that much. Technologies have gotten better, yes, but I would say not like order of magnitude better. Maybe there's some better business models on like using AI and like, you know, how do you look at how climate is affecting different businesses? But the big question I think is, has the customer demand changed versus the previous kind of cycles, such that they will actually pay more money for, you know, maybe more sustainable technologies, more sustainable products? That I'm not sure yet. I do think there's more demand there, but it's still unclear. You know, one of the most famous last sayings in venture is like, oh, it's different this time. You know, when you're talking about some sort of bubble or inflation. So there's definitely a ton of money. There's like a gob loads of money at the mid to late stage trying to find ESG deals to invest in. Not that many early stage deals. So we're trying to figure out, you know, are there enough ESG deals to suck up this money? Maybe you want to play the capital game. If you're an early stage kind of climate or sustainability company and you get to that mid stage of venture, there's going to be tons of capital waiting for you, right? So from that game, maybe it's good to invest in these deals to get them to that point. They'll exit. Whether they're a good company or not is an unclear question. I mean, as to SPACs, like, you know, a lot of companies went SPAC. Still unclear they're good companies, but investors got their money out.
So Holman, what is that tipping point that you just described? What does that look like?
For ESG companies?
Yes. To get sort of through that valley of darkness to a place where there's a lot of capital. What point is that?
I mean, the cynical side would say you just look half good at this point, right? You look like you have a half good idea, and it looks like you can maybe make money. I do think there are different interesting business models and companies and technologies which can show they can find some niche in actually generating revenue, which isn't dependent upon subsidies or, you know, the general feel-good environment of the consumer. Like, they actually do make money on their own. I think those will just get tons of money.
So where's the validation point? Is that 2 million revenue, 20 million revenue, someplace else?
I would say still pretty early on the lower side of that.
Okay.
You know, I think the big question then becomes is, can all these companies become sustainable, like no pun intended, by themselves, right? Like, I see a lot of companies trying to do, you know, new biomaterials, new bioplastics, or new ways of producing food. I think all those are very interesting, but the problem is, can you do it in a way that the price difference is not significant? Like, petroleum plastic is super cheap. Right now, plant-based plastics are much more expensive. I can see customers paying the 10-20% premium for that, but will they pay a 3x premium for that? Probably not. A very small subset will do that. So if you can get that price down, or figure out a different way of how using these plastics, then I think there's a way to make money.
Speaking of making money, so enterprises, I think they're concerned with this whole talk about digital assets. Everything is open, it's transparent, and they're worried about how they're going to protect their IP. And, I mean, your opinion, how can enterprises take advantage of this new digital phenomenon that's going on today?
Yeah, there's probably no clear access to that. People are paving the way as they walk on it, right? But from an enterprise perspective, I think companies are much more open to at least starting to understand this new marketplace and how to play in that. So a big example is Visa bought one of those board apes, right? And they've been experimenting. They've been trying to figure out what access to people does it give them. So they're not buying the board ape just for the marketing purpose, but just for the IP purpose of it. They're looking at it as a marketing tool. Can they now be involved in a new community of users where they can go out in very targeted fashion, sell their own services, right? Same thing happened with Gucci. Gucci, I think they sold a physical bag for $3,000, and then they sold an NFT for that exact same thing for $4,000, right? Now, does that, what does that prove to them? it's that their selfish approach, like they've done with patents and trademarks over the last 100 years or so, they're probably going to be in a little bit of a worry, because transparency is the key here. If you own something, you have to bring in your community to be part of that experience as well. And if you're not able to do that, and you're going to just send out cease and desist letters, I think that's going to backfire in this kind of a community and trying to do things transparently.
So I want to say in the transparency theme with Rob, in the spirit of transparency, I mean, should we be concerned about some of the increased government regulation, both in the U.S. and international? I mean, is that?
Yeah, I guess I previewed that a little bit earlier. So I'm not an anti-regulation person, but I definitely think that, so what's changed in the world? We've become more nationalistic as a world. We've become more protectionistic. This is bipartisan, in my opinion, by the way. We distrust tech now. The we being the global, the we. You see the reaction, you know. The two enemies of both parties are technology and China. Both parties can't get at tech companies or China fast enough. We have to watch this. I mean, I think from a regulatory perspective, for tech companies are going to have antitrust issues. It's going to be much harder to buy other companies. And you know, sales to Fang or whatever, I guess it's called Magna now. We have Meta instead of Facebook. So sales to Magna was a great exit. You know, you didn't have to worry about an IPO. You just sell. Sell to Zuckerberg. Sell to whoever. That's going to be harder to do now. The FTC announced last week that if you do a consent decree with them, if you want to buy another company in that same segment, and they haven't defined what that is, you need their prior approval for the next 10 years. If you think about it, wow, it's an eternity in the tech world. So we have to watch these tendencies. President Biden appointed a very aggressive FTC commissioner. She's very focused on antitrust, and it's disrupted the world of antitrust from used to be just about what's for the consumer. Now it's much more around data, privacy issues. You see, California passed its own version of the GDPR, which is the European privacy regulation. It doesn't really affect our day-to-day lives very much, but it reflects this distrust that happens even in a very, I think it was a very technology favorable state like California. We have the CCPA. So those are the things that concern me a bit going forward in terms of deals. I think people, if deals make sense, they'll still do them. I don't think regulatory conditions necessarily stop deals, but they create more deal uncertainty, and that's what causes deals to slow down. And so I do agree with Haman that I think 2022 is going to be a big, gangbuster year. Maybe it'll be slightly less busy in 2021, but I'll still be very busy. There are a lot of underlying things, but I think this is something to watch for all of us to do deals.
So you're ready to do 80 deals in 2000?
I'm not sure physically I'm ready to do 80. We'll do whatever the clients want us to do.
All right, I have a couple more questions for the panelists, but I'd love to hear in the audience, is there anything on your mind, anything you want to ask?
I'm interested. Is this a good time to invest?
Let's sit down and talk about your
We have wine afterwards. Great conversation.
It sounds like you should be buying
No, but that's a
something.
serious question. Good time to invest.
That's what I was going to
Yeah.
ask. How are you advising your clients when they come and say, well, inflation is a big risk, but on the other hand, we're seeing enormous gains with crypto assets, Bitcoin or Shiba,
Yeah,
which is the flavor of the day.
right.
So what do you have to say to them?
I certainly think there's an allocation in a portfolio with cryptocurrency. I agree with you. It's life changing, and it's just that part of the technology advancement where things are a little bit nutty, right? Think about electricity back in the day, right? You had people literally hanging from lamps, dead, shocked themselves with electricity, right? So that's the kind of thinking I think that we're currently in, right? Like there's a bunch of frothiness and craziness. So I say eyes wide open, right? BNY Mellon currently
separate asset class that is appropriate in the right circumstances.
Yeah, I would, going back to that concept of risk control and risk assets, it's definitely in the risk assets bucket for now, right?
Can I just make one observation? I don't want to, I think it's kind of funny we just spent time on talking about ESG, and then we started talking about crypto, and nobody's talking about the fact that, I don't know how you have an ESG portfolio that relies a lot on crypto because of the computing power and the energy required, no offense. I mean, this is where I get a little bit, I think, and we have, by the way, we have venture capital fund clients who have hired ESG consultants because their LPs have asked them to. And then they feel like they've given an advantage of raising capital. But some of this ESG stuff is just not real. Sorry, it's just not real. It's lip service. And it's, also ESG is a massively wide area. It's environmental, it's also, social justice, it's all are good things, but to combine them all together is like, it's dizzying. But anyway, I just keep waiting for somebody to say, how's this gonna work?
But some of those things are also red herrings, right? Because yes, if you look at the Bitcoin, it's very expensive to operate that whole blockchain.
Yep.
And it demands a lot of resources to run it.
Yep.
But then you're also thinking about how does that compare to the existing financial system that we have?
That's
Right.
valid.
So that's the fair comparison.
Yeah.
I mean, all of those comparisons that Bitcoin consumes more electricity than Denmark, I think those are red herrings.
And that problem gets solved technologically
And
as
that's
well, right?
that gets solved. I mean, you're seeing so much of renewable sources of energy going into Bitcoin production right here in the US, in Texas, in Iowa. Right. So that energy mix is already changing. Now, does it happen overnight? Probably not, but over a period of time it will.
But I hear you. I just think, Musk, backed off blockchain because he got blowback on the environmental side, then he went back. I think it's something that has to be dealt with, right? That the movement has to deal with. Again, if we're
Well, I
gonna
think
deal with this
billionaires have their
process.
own motivations of why they do certain things.
Sure.
So I won't get into that.
So my second question is ESG just a new name for social impact investing, or are they actually different? And anybody who's
I mean-
opinion on the question is, I'm confused.
I would say, from my perspective, they're different, right? Impact investing is building single-family homes and areas that we need to resurrect. We need to get better. We're investing into those communities. I think ESG is those companies that are doing the right thing, right? And they're being
That was the
conscious.
intent of social impact investing, that you're doing the right thing and you're making money doing it.
Yeah,
And
and
you're doing the right
ESG
thing
is more
and you're making
about,
money doing it.
let's review each company and score them on 6 different levels and make sure they're being, they're doing right for the environment. They don't have class action lawsuits, there's, and if, executive teams are doing the right things, that score is a little bit different on the way I look at ESG than impact investing, right? And both, you can make money in both segments, and that's where, a lot of clients, they want a portfolio that's more of a reflection of their values and what they do, and impact investing in ESG happens to answer some of those questions.
I'm all for that. I didn't mean to. I just think what I don't think.
We had
what ESG has become this. To me, ESG has become this. I'm going to hire a consultant and check a box, as opposed to really having an impact. I mean, I believe in impact investing. We all try to do some of that ourselves in our own portfolios, but that's where I get it.
Yeah, ESG just a buzzword is really real, right?
Yeah, exactly. And then to your point, another class of companies I'm now seeing in the early stage are companies that are measuring companies' actual ESG impacts and performance for investors. So it's almost like it's kind of getting a little meta in itself. Like, okay, you have an ESG company measuring the ESG quality of the ESG company.
It's like LEED certified buildings.
Well, tune in, we have a whole event on ESG in 2 weeks, so
There we
make
go.
sure
There
to
we
join.
go. Good segue. So it's we're at 6:45. I promised you guys all more wine and food. Thank my panel. What a great panel, right? And look, we do this once a year, where we're going to host an event, and we look forward to doing it either next, November or December, and getting 80 to 100 people in the room. This was their first attempt to have an in-person event, and we're just gonna keep doing it and doing it and doing it, so.
Great job.
Thank you for everybody coming to that.
Thank you.